Hi everyone, welcome back to the channel. I hope everyone enjoyed their holidays, and I know I haven't made a video on this channel in a couple of weeks. I had some people asking where I was, and for the past couple of weeks I've just been insanely busy with a bunch of stuff going on, but I am back, so I am planning on regularly posting again. But I'm just going to make this quick video to show you this one thing you should be looking for when you're looking at stocks to buy. When you're analyzing the underlying company, this is a very important factor in my opinion that you should be looking for when you're trying to understand the business, and that is the capital allocation strategy of a business. In other words, what the management is going to do with the money they make. This is a huge, there's so much waste in a lot of companies where it seems like they're making all this revenue, right? They're making a profit, and then the money just sort of disappears, right? You don't really know where it goes to. And so I've found that the best management teams are often very clear on their capital allocation strategy, right? They leave no doubt to where the cash is going. They have a clear plan. We're going to put cash toward A, B, and C, and this is what we're going to do to make our business grow. And so this is from the investor presentation of a company called RCI Hospitality Holdings. Their ticker is RICK, R-I-C-K, and they are a company that owns and manages nightclubs. And so this is a management team that has a great capital allocation strategy. So what we're going to do is take a look at that and see what their strategy is. So the first thing is the goal of their capital allocation is to drive value with 10 to 15% annual free cash flow per share growth. Obviously, that's a good sign that the company is aligned towards growing free cash flow. As a stockholder, that's really what you want to see increasing every year. And so they have three key parts to their capital allocation strategy. The first one is mergers and acquisitions, buying more of the right nightclubs. So this is a company that acquires nightclubs and incorporates it into their brand. So this is their plan: buy good, solid cash flowing clubs at 3 or 4 times EBITDA and structure these deals to generate annual cash on cash return of at least 25 to 33%. So what this company plans to do is when they're buying new nightclubs, they're going to buy them at a cheap valuation, 3 to 4 times EBITDA, and make sure that they have a high cash on cash return of 25 to 33%. Now, the second part of their capital allocation plan is to buy back shares, but this company does a lot better than other companies do it. If you see what their criteria are for repurchasing shares, the company will repurchase shares when the free cash flow yield is more than 10%. And so this is so key because pretty much all companies now are doing stock buybacks. But the difference between a bad management team and a management team like Rick's, which is high quality, is that poor management teams will buy back stock regardless of the stock price. You know, they say we allocate this many billions towards buybacks and we're just going to buy it back over a period of a few years, no matter what the stock price does. But I think it's best to use share buybacks intelligently and really only buy back shares when it makes sense from a value perspective. So this company uses a free cash flow ratio as their proxy to determine if the stock is undervalued, and the management determines when the free cash flow yield is more than 10%. That's when the stock is undervalued enough that it would make sense to start putting money into stock buybacks, right? And this is something that Warren Buffett also does. He usually does stock buybacks when Berkshire Hathaway is trading at around 1.1 times book value or less. So a very similar thing going on here with Rick's. And they put a little stipulation in during the pandemic. They're only going to buy back shares if their cash exceeds 15 million, right? So again, that makes sense. Make sure you have enough liquidity in the bank before you start putting money towards share buybacks. And then the last part is their organic growth by expanding Bombshells, which is their nightclub chain. Again, they want to structure investments in new units to generate annual cash on cash return of 25 to 33%. And then also they're beginning to sell franchises of these chains. And again, all three of these pillars of their capital allocation strategy goes towards this one goal, right? 10 to 15% annual free cash flow per share growth. And here's another slide going over the strategy from one of their older reports, and it's basically saying the same thing in a different way, right? Their key metric is the free cash flow, but what I like about this one is that they literally show the stock price at which they'll buy back shares. I think this is from 2019 or 2018, but basically the management is straight up telling you when the stock price is under $27 a share, we're going to do stock buybacks. And when the stock is above that, we're not going to be buying back shares. Instead, we're going to be planning on growing through acquiring other nightclubs. And so I just wanted to make a video pointing this out because I think this is so important that if you're buying a stock and you really want to understand the underlying company, part of that is understanding where every dollar of profit is going to be reinvested. If it's going towards buybacks, if it's going towards expansion through acquisitions, or if it's going towards organic growth. Now we can take a look at Rick's stock. This is a company with a very good management team and a strong history. This is one I was looking at buying during the drop in March where it was trading under $10. Ultimately, I didn't buy in. Obviously, looking back, that was a mistake. Now we're touching just about $40 a share. So for my opinion, this one's run away too far. So I'm not going to chase it now. But if we do see the stock ever fall back down to around $20, that's where I would consider taking a position in this company. And you can see even after this run up, they still don't look that expensive. Their forward PE is just 13. So I mean, even with this huge run up, there still could be more upside. Again, I'm not going to chase them after they've run this much, but this just shows you what a good management team can do for a company and the stock. So that's all I wanted to go over for this video, showing an example of a great capital allocation strategy from a quality management team. I'm trying to find more companies that have management teams like this, so let me know down in the comments if you found any companies that do a similar thing and have a clear strategy for when they do things like buybacks. So that's it for this video. If you found value, hit the like button to help out my channel. If you're new here, subscribe and click the bell icon so you get notified whenever I upload a new video. So that's it for now, and I will see you next time.